Hello everyone. The Indian equity market witnessed a healthy correction since the beginning of this year, led by rise in US bond yields, Indian PSU bank governance issues, trade war related noises, as well as natural correction of some of the excesses in valuations. So how do we deal with the correction in uncertain times? By simply taking lessons from history. In the raging bull market of 2003-2007 period, we had close to 13 corrections of more than 10%, and all of them proved to be great investment times. Similarly, we had the Lehman crisis of 2008-2009, or even deflation scare China-related slowdown in 2015, when our markets too corrected by about 20% in nearly 4 months. Similarly, in 2016, markets faced demonetization-led correction for about 2 months, and all of them have proved to be great investment times. Fundamentally, while India macros may have deteriorated at the margin in terms of fiscal slippage, current account deficit, the micro numbers seem to be very encouraging. Industrial and economic recovery appears to be firmly in place. The December quarter results reflected good earnings growth, and we expect broader earnings growth of close to 20% per annum over the next 2 years. Coming from a low base of demonetization and GST, as well as led by accelerated government spending. There is again a historical perspective with respect to the pre-election period, wherein the index of industrial production or economic growth tends to improve on the back of government spending on rural, agriculture and infrastructure. And this should support earnings growth as well. Besides, globally, in the medium term, with return of inflation and rising interest rates, eventually, though gradually, emerging markets should perform better versus the developed markets. Currently, global market is grappling with the trade war noise and related uncertainties. At this point of time, it is too early to talk about its probable outcome, as well as it is a nascent and hazy stage. Relatively, India could be a potential beneficiary. Amidst all this noise, US S&P 500 corporate earnings are expected to sustain strong earnings growth that should fundamentally support any major downside. In India, we are seeing credible progress under the Insolvency and Bankruptcy Code in resolving legacy issues, NPA issues across steel, power and other sectors. On the earnings front, March quarter could see good numbers from auto, non-banking financial services companies, retail private banks, metals, energy and infra companies, especially on the road side of business, while private sector corporate lenders, pharma and telecom sector may report weak financial results in the near term. As a portfolio strategy for small cap equity fund, we have focused on companies in the agriculture sector like seeds, crop protection products, farm mechanization products like tillers and tractors, pipes and micro irrigation systems that will benefit from greater rural and agricultural spending and expected rise in farm incomes. Besides, we like other businesses like aqua farming, specialty chemicals, NBFCs and selective companies in the engineering and infrastructure sectors where we believe the order book to bill ratio gives us higher growth predictability. Against the backdrop of recent correction and expected volatility from global markets and run up to elections, we continue to hold and add selective opportunities in several small companies across diversified businesses that should sustain earnings growth and which are available at reasonable valuations. This strategy has potential to eventually provide alpha or above average performance to the investors. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.